Hello, everyone. Let me ask you a question. When you filled out the beneficiary designation form on your life insurance policy, did you put 50% IRS? I sincerely doubt it, but you may have done it inadvertently. In this podcast, we will talk about how to avoid doing that.
Retirement Planners of America, RPOA.com.
Hello, everyone, and welcome to the Retirement Planners of America podcast. I am Ken Moraif, the CEO and founder of Retirement Planners of America, and I hope this podcast finds you healthy, wealthy, and wise. In this episode, we're going to continue in our series of estate planning podcasts, basically how to pass on to your greedy, unwashed, undeserving heirs the fruits of your labor in the least taxed, most cost-efficient way. And in this episode, we're going to talk about your life insurance and how potentially you could leave 50% of it to the IRS inadvertently. But more importantly, we're going to talk about how to avoid doing that. So I'm going to bring Jeremy into the combo. And by the way, we're going to have more fun than a human being should be allowed to have when talking about this.
I love that. I love that so much.
Do you?
Yeah. It is so exciting. I had a choice. Right now I could be on a yacht.
In Ibiza.
Yeah, yes.
With Kim Kardashian
Right.
or
And I said, guys, I appreciate the invitation. I have more important matters. In reality, it's a lot more fun to be here.
Wow. I'm honored and flattered by that.
Absolutely.
That's great. So let me ask you that question, Jeremy. On your life insurance policy, if I were to pull out the beneficiary designation form,
Right.
Does it say 50% to the IRS and 50% to whoever else you left it to?
You know, I've heard really good things about the IRS, but
Yeah.
I have not placed them on the beneficiary list.
What? You don't like the IRS?
I like them. I just don't like them I don't like them like that.
Okay. All right.
Yeah.
You have a different love for them.
Yes, that's correct.
Okay. So let's talk about that then. So how do they go about determining? So first of all, this may come as a shock because
Yes.
people have heard that life insurance is tax-free,
Right. Yeah.
right?
Yeah.
But it's not. It's income tax-free,
Oh, that's very specific.
but it is not estate tax-free.
Okay. That's a big difference.
It's a big difference. And since we're talking about estate planning,
Yes.
it falls into that side of it. So life insurance is tax-free from an income tax. Nobody pays income taxes on the proceeds of a life insurance policy.
Okay. Okay.
Okay, so the beneficiary that receives the money, nobody pays anything. But there is estate tax potentially on the value of that policy upon your death if it increases your estate to the point where you have estate tax.
Interesting.
Yeah. So, Jeremy, when it comes to estate planning, what is almost always the answer to that?
You know, I feel like this is a trustworthy subject.
You know, I trust you when you say that.
I appreciate that. I'm going to guess it's a trust. That's
It
a
is
guess.
a
Yeah, okay.
bingo, bingo, bingo. All right, so, and as usual, these trusts have acronyms.
Yeah, I can't wait to hear this one.
Okay,
Yeah,
this is
yeah.
a good one. So this is the Irrevocable
Okay, hold on. Okay.
Life Insurance Trust. And you know what is the acronym for that?
ILIT?
ILIT.
Okay.
And that's what we call it, an ILIT, ILIT, Irrevocable Life Insurance Trust.
Okay.
So let's walk down the ILIT lane in this very trustworthy world. Are you going to trust me on this one?
I think you are trustworthy enough that I can trust you on this.
Okay, so
Yeah.
all right, so let's talk about it. So basically, when it comes to your life insurance, there are 3 tests that the IRS uses to determine whether the life insurance policy is going to be included in your estate and
Okay.
therefore potentially subject to estate tax,
Okay.
or it will not be included in your estate, in which case there is no estate tax.
Okay.
All right. So the first test is, who is the premium payer?
Okay.
So if you're paying the premiums on a policy, and by the way, you don't have to meet all 3 tests. If you meet any one of the 3,
Oh, okay.
then it's in your estate.
Okay.
So you want to avoid all 3 of these because any one of them includes it. So the first one is, who's paying the premium on this? So if you're paying the premium, then they consider you to be the owner of the policy, and therefore it's included in your estate.
Okay.
Number 2 is who has what are called incidence of ownership. What that means is who has the right to change the beneficiaries?
Okay.
Who has the right to, change the workings of the policy, whatever it may be. If you have the rights to do that, you may not be paying the premiums, but you have those rights, they're going to include it. They're going to say, well, yeah, but you're the owner, okay?
Yeah.
And then the third is pretty simple. Who's the named owner?
Okay.
So you just open up the policy, and if it says owner and your name follows, guess what?
That's you.
You're the owner. So that was pretty basic. So if we want your life insurance not to be included in your estate, we have to have somebody other than you meet those three tests.
Okay.
Somebody else has to pay the premiums, have the incidence of ownership, and be the actual owner.
Okay.
And since you want to control things from the grave,
Right.
you want that to be a trust.
Yes, absolutely.
And the trust is the ILIT.
Yes.
All right, so you create the ILIT. Now, once you've created the ILIT, you have a trustee, which is not you, and the policy now, you want it to be owned by this trust.
Right.
First test, the ILIT owns the policy.
Right.
And you want it to be owned from the get-go. Because if you transfer an existing policy into a trust and you say, now trust, you're going to own this policy that I already have, there's what's called the 3-year contemplation of death rule.
Okay.
This one was created by Darth Vader, I think.
Yeah, I was like, golly.
Yeah. Well, what they don't want you to do is like, oh, gosh, I just found out I've got
Yes.
6 months to live.
Right.
Let's put everything into a trust and,
Yeah.
that way no taxes. So my advice is that if you're going to put a life insurance policy into a trust, an existing one, change the owner, don't die within the first 3 years.
Okay, I love that plan. Everyone can really set a plan for that.
I highly recommend.
Right on
that-
the calendar.
yeah,
3 years from
3
now.
years from now, you
can die.
you're now free. So but if the trust owned the policy from the get-go,
Right.
then there's no 3-year contemplation because it owned
Okay.
it. So you create the trust, and the trust says, I want to buy a life insurance policy on Jeremy. Okay, fine. Now you have a trustee, and the trustee is who's in charge of this policy.
Right.
Therefore, those incidents of ownership that I was talking about, that falls to the trustee,
Right.
right? So if they want to change the premium, if they want to mess around with what's happening with the cash value or whatever it may be, that's the trustee, that's not you.
Yeah.
So that's second test passed. So we got the owner as a trustee has incidents of ownership. The next thing then is the premium payment.
Okay.
And this is where it gets a little complicated because the trust has no money.
Right.
You just created this trust and it has no money. So where's it going to get the money to pay the premium on this policy that you want it to buy?
Yeah.
Well, that's where I'm making you the grantor.
Yes.
Okay, so now you're the insured person.
Yes.
Because it's at your death that you want the money to be paid. And so we make you gift to the ILIT, to the trust,
Yes.
money so that the trust can now pay the premium with.
Interesting.
Now, there are some rules that go with that.
I'm sure.
So, number one, as I said before, you cannot write the check, right? The trustee has to. So you have to give the trustee the money so they can write the check for the
Okay.
policy.
Yes.
Okay, so this trust has to have its own bank account.
Yes.
So it receives, and usually these are set up where the premium is due annually. So once a year, the premium gets paid. So there's an interesting story behind this. And there's a family, I think back in the 60s,
Okay.
called the Crummey family.
Okay.
It's MN, not MM. So it's not
Yeah.
crummy as
Yeah.
in crumbs. It's Crummey.
Okay.
Right? So
Okay.
Crummey.
Okay.
And so this family, wealthy family, hired some very smart lawyers. And they came up with this idea because if I give somebody money and then they do that, the IRS looks at that and says, this is a sham transaction. You
Right.
know, yeah, right. You just gave them money. They're buying the premium. This is all to
Yeah.
get around the whatevers, right?
Of course. Yeah.
So what they said was, but wait, what if the way that I can prove that this was not for the purpose of paying a premium is that I have to make it a completed gift,
Okay.
meaning that the beneficiaries of this life insurance trust, my kids, in this case, the Crummey family's kids, have to have, for a moment, the right to take that money out of the trust and go buy a Ferrari with it or whatever they want to do.
Okay.
They have to own it for one moment. And if they own it for that moment, then you can't say, because they could, kids are unpredictable, right?
Yeah,
They may say, what the heck with the life insurance? I want that money.
Yeah.
Right?
Yeah.
So they can do that. So how do we make the money that you give to the trust for the benefit of your 3 children, let's say, into a completed gift?
Okay.
And this is what the Crummey family came up with. So what happens is the gift arrives, and you just made the gift. So let's say it's $20,000. So you give, or 3 kids, $21,000. So you made a gift of $21,000 to the trust. The trustee now notifies the 3 kids. They're beneficiaries of this trust.
Right.
Guess what, kids? Your parents just made a $21,000 gift. You're each entitled to $7,000 of that. Do you want the money?
Okay.
And then the kids go, and they have 30 days in which they can say yes or no. Now, after the 30 days, they have to respond in writing that, no, I do not want the money.
Right.
So once they don't want the money anymore, the trustee goes, okay, what do I do with this money? I got this $21,000 burning a hole in my pocket.
Uh-huh.
And so they pay the premium.
Okay.
And so because it was a completed gift to
Yeah.
the kids,
Right.
so it's very important that they're called Crummey letters.
Yeah.
These letters were invented by the Crummey family, so they're called Crummey letters. And there's a whole process that you go through. It takes 30 days. And the reason why the 30 days is because kids can come up with all kinds of reasons why they want that money in 30 days,
Yeah,
right? So
of
you got to
course.
give them time.
Yep.
You can't they get the money and that very second, no, I don't want it. Then you want to make it actually realistic.
Yes.
That the kids have the opportunity to take that money and do something else with it, and the premium is not the guaranteed thing that this is for.
A reasonable amount of time.
30 days.
Yeah.
So once that happens, now the 3 tests, 3 tests, are met by the trust.
Yeah.
The trustee paid the premium. The trustee has the incidence of ownership, and the trust is the named owner.
Yep.
And now the value of that policy is outside of the estate.
Wow.
Yeah. So now, as I was talking about before, you could have a situation where somebody is, you want to do it. The perfect way to do that whole ILIT is to buy a brand new policy.
Yes.
But in circumstances where somebody's health does not allow for that,
Yes.
then what you want to do is move your existing policies into the ILIT so as to have them escape from estate tax. And as I said, there's a 3-year rule for that. So you have to sit tight and not die for 3 years.
Yeah.
That's my assignment.
Yeah.
That's what we tell people. Your assignment is not to die in the next 3 years, because then
Yeah.
you're going to screw up the whole plan.
Yeah,
And we
right.
we don't want that to happen.
Yeah. That'd be a lot of paperwork. It'd be
Yeah.
super annoying.
Now, the ILIT can be designed to be a dynasty trust, which we talked about in a previous podcast, meaning that the proceeds of that life insurance policy are now in the dynasty trust for, in this example, the 3 kids.
Yes.
They each have their own separate dynasty trust.
Right.
And ladies and gentlemen, if you don't know what a dynasty trust is, we're not getting into it here. Go watch the podcast on how to protect the inheritance for up to 100 years, and we'll explain it in detail there. But basically, the proceeds could be hermetically sealed in this ILIT, which converts into a dynasty trust,
Wow.
and can be protected for them from lawsuits, divorce, estate taxes, bankruptcy, for potentially 100 years.
Yeah.
So work this all together, and it can be a pretty terrific thing. So again, what's our disclosure?
You should talk to a professional, your professional. We'd be happy to sit down and talk to you about any planning. But before you take any action, please talk to someone that does this for a living.
Yes, we're not lawyers, but one thing we can do is give you enough knowledge that when you are talking to your lawyer, that you know the questions to ask, and you know generally what you want to get done, and you're not running up the legal feet clock on the learning curve.
You talk like an auctioneer.
Have you ever noticed that when you're talking to a lawyer, they always want to joke around with you? And I'm thinking, this is costing, every single second of this is costing me money. Let's cut to the chase here.
Yeah. Get down to business. Come on.
So, ladies and gentlemen, again, as we always try to do, is to have more fun than a human being should be allowed to have when talking about all of this boring financial stuff. Hope we did that for you. We specialize in working with people that are within 5 years of their retirement or are in the first 5 years of their retirement. And we consider that 10-year period, that decade, to be the single most important period of your entire financial life. It's going to set the stage for the next 30 years, hopefully, of your retirement. Doing it properly in that decade is super important, and probably you have no experience dealing with things about that have to do with after you retire and living on your money and all that. We do, and we would love to work with you if that's appropriate. So again, thanks for watching. Hope this found you healthy, wealthy, and wise. Please like and subscribe. Thanks to you, we've had over 1 million views of our podcasts and our market alert videos. Love you for that. Thank you, and we'll talk soon.
Retirement Planners of America.